So what we have done is we have built a proxy for in this case, the IUL product. So we say the proxy is a fictitious hypothetical investment that behaves very similar to certain real world products, in this case, the IUL. So if I go back about a decade or so, I went around to all the carriers and talked to all of their compliance departments, all their advanced markets attorneys, all their actuaries, and said, look, what I want to do is I want to build a model that's more educationally based for clients, where we can explain to them how floors and caps work, how volatility can affect final outcomes. We want to show them how the charges are structured and how the charges work. And they said, well, you can't rebuild a life insurance illustration, right? That would be non-compliant. But you could build this proxy model that you're talking about as long as you had the right disclosures. So that's essentially what we did. This proxy basically is built so that it behaves very similar to the IUL as it pertains to the contributions that go in would be the same as the premium schedule. The beginning of year charges are the same as the premium load charges. The monthly charges are the same as the remaining policy charges. The end of year credit would be the same as whatever the product's floor and cap would allow. We even built in there a participating loan option where we can model the depiction using the same participating loan rate as the product that we're evaluating. And then we backtest this. We use historical S&P 500 returns during 121 different historical 40-year periods, which I know seems like overkill, but we really wanted to be able to explain to the client, these are all the different outcomes that in theory could have existed based on the design of this product with all the volatility. And then lastly, we also can show historical borrowing interest rates. Now, this is extremely important when it comes to premium financing because all of the firms out there that were selling premium financing solely based on low borrowing interest rates were really doing the client a disservice. You don't do premium financing because borrowing rates are low. You do premium financing because you understand over time the spread or the arbitrage between the borrowing rates and the crediting rates. Well, when we go back and show historical returns and historical interest rates, in some years there was a positive arbitrage between the two, and in some years there was a negative arbitrage. What our backtesting software does, it can actually show with a client how that relationship works and how it has worked over time. So our model, again, we model 121 different 40-year periods. And then we tagged the 40-year period that produced the best compounded annual growth rate out of those 121 different periods. And we also tag the period that produced the worst compounded annual growth rate. I always like to focus on the one that produced the worst compounded annual growth rate, just to be conservative. And I would always rather under-promise and then over-deliver. So in our model, we actually can extrapolate the charges and then model what the credits would have been in each one of those back-tested periods. So here's an example of what I mean by this. We have these charges and credits pages in our proposals. I know it's a lot of information here, but we can show them in this scenario here. Again, this is the 40-year period that produced the worst compound annual growth rate. This started right in fourth quarter of 1971. And what we'll do is break it down for them. So let's say in 1982, the S&P return was just over 37%. Based on a 0% floor and 10% cap model, the index credit in that year would have been 10%. So in this particular design with this particular crediting method, in that year, they would have gotten a $1.6 million credit. There were $42,000 and change worth of charges in that year. So the cash value gain in that year would have been just over $1.5 million. However, let's say in 1989, the S&P took a negative 12% hit, which means the policy would have credited zero. So in that year, there would have been $0 credited based on the index credit. There was a $58,000 charge in that year, so your cash value would have decreased by $58,000 in that given year. If we're using a product with, say, a multiplier bonus, in addition to the cap, you would take that 10% return multiplied by 1.96, that is the multiplier bonus, and so the effective index credit in that year would have been 19.6%. and the cash value gain in that year would have been $721,000. However, in a year where you had a negative return and you would have gotten a zero, well, 0 times 1.6 is still 0. They would have, however, incurred the multiplier bonus costs, which are pretty expensive. So in that year, the cash value would have decreased by $466,000. So we want to be able to show the client how this process works. And a lot of agents at first glance will say, Darren, this is too much information. My client does not want to know the details. Let me tell you something. This client's buying a $30 million life insurance policy, and it's going to have interest payments in the 7 figures. They're going to want to know how the charges and credits work. And even if you don't think they do, years into it, if the client has questions or things just don't go as well as hoped, and the client becomes litigious, you want to have something in the client file that proves that you talked about interest rate volatility, that you talked about how a floor and a cap works, that you talked about how charges work. And so that's part of what my firm does as a service when you do joint work with us in premium financing, is not only will we have all these reports in the client file, we also produce a 30 to 40 minute custom video where it's my voiceover going over the client's custom proposal. We then upload that video to the cloud. We then circulate the link to that video so that the client can rewatch the articulation of how all of this works. They can pause it, they can rewind it, they can watch it a gazillion times if they want. They can send that link to their spouse. So their spouse hears me explaining it as opposed to the prospective insured explaining it. They can circulate that link to their attorney or their CPA or their idiot brother-in-law or whoever it is that wants to understand what's going on here. At least they're hearing a compliant, accurate articulation of how this actually works. We can even get into participating loans and how those work. So we show them here. In the 11th year, we're showing the bank payoff. We're showing the cost recovery drawdowns. And we have the ability to show the policy loan interest that's being accrued right next to the cash value gain that they're getting by leaving that money in the index account. What's really interesting here is over time here, over a 40-year period, the positive arbitrage between the participating loan amount and the index credit amount is over $31 million to the positive. And again, this was during the 40-year period that produced the worst compounded annual growth rate. I know this is a lot of data, it might even be overwhelming, but I just wanted you to see that the due diligence has been done and is well documented in the client file. This is a great depiction here. So the dashed green line here is the simulated account value during the best 40-year period. The dotted green line is during the worst 40-year period. The blue line is the actual as illustrated cash surrender value in the carrier illustration. I think this is really encouraging because it really speaks to just how conservative that carrier illustration is, given the fact that the simulated cash value during the worst 40-year period out of 121 different periods we analyze is substantially greater than the as illustrated numbers in the carrier illustration. In addition to that, the black line is the as illustrated death benefit in the carrier illustration. So I find this really interesting because in a real world scenario, if the real world product had a cash value that looked similar to any of those green lines, if the green line eclipses the black line, the death benefit cannot be less than the cash value. It would automatically push the death benefit north of whatever the cash value actually was in a real world scenario. So very encouraging. Great way to stress test the product as well as the design. Now the solid green line here, this to me is one of the most important things to look at, especially in the environment that we're in right now. This is a synthetically constructed 40-year period. The first 20 some odd years start out between the years 2000 and 2021. And then after that, we're showing a static return of 5.4%. Why is this so important? The reason is that some folks are looking at life insurance in general and saying, hey, I think we're headed into a recession. I'm a little worried. Maybe this is not the right time to do it. In addition to that, they're saying interest rates are also high right now. Right? So I'm paying a lot of interest, but not getting a lot of credit in the policy. Right? Well, that's what they think. which is why, again, historicals don't lie. So here again, we have the years 2000 through 2021. We have in column 12 there the actual historical S&P returns. In column 13, we have applied the 0% floor and the 10% cap. Okay, after that period, then we're just doing a level 5.4% return. So if we blow that first 10 years up there, this is how bad it is, right? We got 1, 2, 3, 4, 5 negative S&P returns in the first 10 years of the sequence, in which case the policy would have credited 0, 5 out of the first 10 years, and even more specifically, 3 0% return years in the first 3 years back to back to back of the sequence. That's pretty adverse. But if we look at historical borrowing rates during that time, at least with one of our lenders, it tells a very interesting story here, because in the year 2000, the borrowing rate is higher than the borrowing rates are today. But what happens, again, historically speaking, is as soon as there is a crash, there's a 2-year lag where the borrowing interest rate comes down, again, historically speaking, 2 years after a correction. So the borrowing rate went from almost 8% down to 4% and change, decreased down into the 3%. And then when we came out of that dot-com bubble, market had a 32% return, and now we see borrowing interest rates starting to rise again. Then again, we have the mortgage crisis, 2007, and then 2 years later, the borrowing rate gets chopped in half again. So it's really understanding the interrelationship between borrowing rates and crediting rates over time. This is the indisputable mathematical data that we have found is so important to show a client, because if you just hypothesize about these concepts, that doesn't give anyone any sort of real confidence. When you can show them indisputable math, that is really what pushes them over the edge in terms of really understanding what the real truth is in terms of the relationship between borrowing interest rates and crediting rates. Again, we go back to that solid green line. That tells a very, very valuable story. And then the last objection we might get here is that, well, I can get better returns in the market. We don't think that the life insurance death benefit IRR is going to be as good as if we invest it in the market. Well, okay, math doesn't care about your feelings. Math only tells you the truth, and historical math is indisputable. So on the left-hand side of the screen there, the green dashed line there, that is the greater of the as illustrated death benefit and the simulated cash value during the best 40-year period of the 121 periods we analyze. The blue line is the same contributions going into that non-insurance-based investment account after taxes, after fees. On the right-hand side, same depiction there. That is during the worst 40-year period out of the 121 different periods that we analyzed. So again, if they're doing this purely for death benefit purposes, pretty hard to argue when you look at the numbers there. The last thing I'll get into here is what I would call unsuitable clients and unsuitable designs. This drives me absolutely crazy. There are firms out there and designs out there that have given premium financing a bad name because they were extremely irresponsible. This was reported on in the Wall Street Journal as well as Forbes. You can actually Google premium financing lawsuit, Wall Street Journal, or Forbes, and you can read the actual article. The client is accusing the premium financier and the agent of being really irresponsible. Here's essentially my point with these over-leveraged, irresponsible premium financing designs. So I ended up manufacturing this, again, using the same client profile we looked at before. And this design, by the way, I don't do this design. Okay? This is pure, I'm mimicking a competitor's design, and there is more than one competitor out there that does this type of design. I'm showing a severely lower borrowing rate several years out, which may or may not happen, right? I would not want to sell a case based on promising or even inferring that the client might get a 2.5% borrowing rate 11 years out. Okay, peak collateral 13.5 million versus $1.8 million was the high point of my design. But then we ran this assuming that the borrowing rates dropped to 5% instead of 2.5%. I'm showing here the worst 40-year period of all the periods we analyzed here. Now the peak collateral is 19 million instead of 13 million. And after you pay the loan off, the client's going to have to come to the table with an additional almost $17 million out of pocket versus between $6 and $7 million out of pocket if this is designed more conservatively. So, do you want to take the risk and do all this? I mean, in theory, you could, but here's what happens when you sell a free insurance deal and then the client finds out it's not free.
Okay, so I hope you enjoyed today's webinar. And after seeing our capabilities, I think it's pretty obvious that we do a lot more than other premium financing intermediaries in this space. Now, I'm sure you have some detailed questions about how we would work together on cases. So get with the person that you invited you to this webinar, and they'll coordinate a private Zoom Q&A session with me personally. And if you found us on your own through an online search or something like that, you can reach out to us directly and call my office, and they will schedule that private Zoom call between us as well. You can call us at 949-398-0088. It's right here at the bottom of our screen here. Or you can go to our website at landsmarkcapital.com. That's also right here at the bottom of the screen. And you can click on About Us or Contact Us, and you can request a private Q&A session with me personally there as well. But in any case, I look forward to meeting you one day soon and providing the very best premium financing solutions for you and your clients. Enjoy the rest of the day.